hope you are strapped in, because in today's bootcamp video I'm going to show you how to trade using the MadBlock concept. Now the MadBlock concept is a concept that was derived from back in the day when I was trading with options and futures. I was using a tool called volume profile. Now you probably might know what volume profile is, and volume profile is a tool that I put on my charts where I can have a look at where the overall volume is, in short summary. Now I can look at the volume area high, the volume area low with typical volume nodes, and then I can see where the most volume, the POC, which is the point of control, that is where the most volume of the day is being traded at. But the caveat with volume profile at this point is I'm trading Forex, right? So if I'm trading Forex, I cannot see actual data. And that might confuse you sometimes because you don't know, am I trading real data or am I trading fake data? You are trading real data, but it is derived or from something. Okay, I know that the Forex market is a $6 trillion market. It's a big market, but a lot of it is liquidity from algos. Now, I don't want you to be scared. I need you to understand where this comes from so we can utilize that weakness and make it our strength. And the thing with volume profile is that when I am trading Forex, I cannot see actual data. Okay, so that is something that you need to remember. But I can also use that into my advantage, and I can utilize that as my strength point. Now, volume profile is an amazing tool to say the least, but it comes with its pros and cons like any tool in trading. And why do I want to see where all the volume is at? So I can make a decision and come to a certain point where I can say, okay, I am trading with the overall volume, or I am really just away from where the overall market sentiment is. Let me show you what the volume profile looks like. So just on TradingView, when I trade volume profile, I use another software, but TradingView is free for everyone to use. I don't think the volume profile is free though. I know TradingView is free. I'm not too sure whether volume profile is free, but it's okay. That's not the purpose of this video. I just want to show you where it comes from and how it looks. So typically I like to look at volume profile on the 30-minute and just give it a second to load. All right, there we go. So you can see that my white line is my POC. You can see my value area high, my value area low. Now value area is the colors are a little bit darker than the normal colors. Just make it like so. And then it's 70%, where the overall 70% of the volume was depicted from the previous day or from the current day. Now this is just giving you an idea of what the volume profile is. I'm not going to be using it in today's video. I'm going to explain where the MadBlock concept comes from. And I was trading, back in the day I was trading volume profile, and I had my mentor who was showing me how to use this together with time and sales and level 2 data. Don't even worry about that. But he showed me this, and I asked him one important question. I asked him, why does everyone claim then that they can see volume on the charts? And he just quickly disrupted that question with one simple answer, and he said it's bullshit. People can't see where the orders are on candlestick charts. I know the industry sells stuff such as order block and stuff. That's a bunch of bullshit in my opinion, but regardless, the volume profile shows where the overall volume is at. And now my question came from, can I use this in theory by looking at the previous day on indices? Because remember, back in the day, they traded equities or put options, call options, and they traded more, well, there were scalpers, but where this came from was from swing trading. Now, not like the weekly swing trading, like an overnight swing trader. And this came from trying to understand where the overnight orders are. And this is where the MadBlock concept was born. Because I was searching on CME, the website, and CBOE. I was looking at all the exchanges, and I was looking at the time and sales, and I was looking at the overall volume, where the overall volume came from. And I saw a particular pattern every now and then. And that particular pattern, to cut it short, this comes from 3 or 4 years just of data collection, and this came from me seeing one specific movement, and that specific movement was the market is dead during the day on indices. This is specifically for indices. During the day, there's nothing happening, but at a specific time, I usually get an entry every single damn time. Now, that happens because overnight orders is back in the day, you would get your traders coming into coming into their job or their office and going to their trading desk. You would have like a desk where the pit is across the floor, and then your trading desk, and you have 1, 2, 3 traders sometimes, maybe 1, 2, it all depends, and then you'll have your runners, and it's a crazy environment. But you would also get a sheet where it gives you an option to place orders, intermediate orders for the following day. And what a lot of traders did is before they went home, they would place their orders. Now the idea here is because they had some information that would tell them that overnight orders, such as during Sydney hours, or the overnight orders, fundamentals would be released, or they don't want to add some options on their trade. They want to actually just manually hedge that position that they're currently in. Regardless what they wanted to do, they wanted to do some trading, okay? And the minute they decided they wanted to do some trading, they added their position. Now, this is not a futures position that saying I will get in at a certain price. Not that that is specifically what futures is, but that is an actual position that they opened, but it only gets triggered the following day sometimes. Sometimes it will get triggered immediately, but it will only get triggered the following day. Now, the problem here is Forex market is open 24 hours a day. And before they would knock off, before they would go home, they would add their orders. We call this stems from a term that we call iceberg orders. They hide their orders. You cannot open 100 billion contracts all at once, okay? That's just an interesting fact. What they did is they will put in iceberg orders, and then at the end of the day go home, of course, and then they would expect a return the following day. It's not like gambling, or even though it might sound like it. I was not there, so I did not know the calculated risk those people took. I just understood their methodology, and now, today, I use it in my favor. So, let's get straight into it, man. The Madlock concept comes from us utilizing that time zone which they stacked their orders. So, if you haven't put 2 and 2 together yet, we are looking for a specific time during the day where the volume was the highest. Why? Because that then means that the following day will act as a form of a key level, because they are trying to protect their overnight orders because they know something that we don't know. So the idea here is, let me just change my time to exchange time. The idea here is the 1530 candle. That is our Madlock. 1530 candle on the 30 minute. That is our Madlock. Now, I don't need you to look on your screen and say, okay, this thing must respect it to the T. It's not going to happen, because then the market will become predictable. We have 4 ways that we look at a Madlock, but today I'm going to teach you one so that you can go home and you can exercise this. Just the exact following day. I like to trade the Madlock in context, of course. I like to look at a low of a session, maybe a low of a day, seeing that the market tested that exhaustion area. And then once the minute the market breaks back and closes inside of my Madlock after a consolidation area, something like this, I would like to anticipate some longs. That's one way of looking at it, is simply just your Madlock zone, and then the market breaking outside and then all of a sudden coming back in. The cool thing that I like about this is this allows you to have your stop loss at the low of the exhaustion area. So it's not your typical stop loss placement area that the industry teaches us, stops below the low, stops above the high. It's not like that, okay? This gives us a visible, tangible stop that we can always utilize in our favor. Now, of course, if the stop loss is this big, it's not going to work. I typically then tend to use 1 bar stops, but whichever one is the smallest, because this thing, Once it grabs that volume, it really just runs. Let's look at another example. 1530. Okay, look here, the market came back down, tested our MadBlock, and then came back down again. MadBlock zone, 1530, break back down, come back up, break above, push back up. We even got another test here on the MadBlock during the NY hours. Now I'm speaking very vague with this concept, but remember there's a typical pattern that we look for, okay? Yes, we are cherry picking our trades because, of course, I'm putting my money on the line. I would like the highest quality setups. But the MadBlock adds as a contextualized zone for you, so you don't just buy low and sell high, just like the norm tells us, okay? This gives you an idea where you actually want to level the playing field, where you actually want to be trading, and then anticipate longs, anticipate shorts, maybe until the high of the day, previous high of the day. But this gives you a basis framework. Now, can you imagine if you add everything together of the bootcamp and you look at the MadBlock again in the same vision? Can you just imagine the amount of confluences and confidence that you have? Let's just look at another one. 1530. Okay, so we had the consolidation inside of the MadBlock. We had the break back below, coming back down, and then pushing back up into our MadBlock. So this typically just forms like a magnet for us, and then the market closed right there. I wouldn't say that that was a trade for me though. MadBlock, consolidation inside of the MadBlock range, break out above with an engulfing candle, something like that. MadBlock right here. Market is pushing back up in the MadBlock, coming back down, breaking back above, MadBlock buy position. Now, why did I not take the sell position once it came back down? Because it's always in context, okay? You always have to look at context. I'm at the low of the day. I'm not going to sell unless we break the low of the day. It always has to be in context. That is why I specifically started with by looking at structure. I'm not going to I'm not going to sell unless we break the low of the day. That's stupidity. It doesn't make any sense. So always remember, it has to be in context. Now, I can carry on with this topic, but you can pretty much get the picture. We are consolidating inside of the MadBlock, breaking back above. Inside of London session, you typically would like to see the breakout, and then more often than not, take the entry off from that. And also, this works on any indice, right? Any equity indice, this works on. So I really would not like questions asking me, MC, does this work on currencies and stuff? I'm really not going to answer that because it works on indices, okay? MadBlock is very short right here. I think it's because the market just closed an hour earlier. And can you see how great it respects the MadBlock? I mean, we got one respect, another respect, and another respect. US 100 respects it more, and US 30 also respects it quite often, but US 100 respects it more, but it just gives you an aggressive run through, which I typically sometimes I do not get the entry from, but it is what it is because it's just so damn quick, man. MadBlock once again, 1530, came back up, tested right here, and then pushed back above. You want that last 30 minutes. So you typically want to think, okay, I'm going to trade on the floor. When am I going home? Because we want to anticipate them utilizing their overnight orders, and we want to pretty much just make money off from that, if I can say it like that. Let me find one more. This was typically a gap formation, but it's also the low of the gap fill with the MadBlock area test, reject, and then push back up. Another one, MadBlock area has been holding as resistance the whole day. MadBlock area low, fake out to the downside with the pre-fundamental event, push back above, break and closure with the engulfing candle, and then rising to the occasion. So yeah, it works pretty well, but you need to build your context around it. You need to form a story for yourself. Look at this. MadBlock running through, coming back down, testing that area, and then pushing back up above. So your homework for today is, now I pretty much hope that you can continue on your own, tell a story, create your own bias, but remember, don't think that entries are everything. In my opinion, I think exits are everything, because you can flip a coin 50% of the time, you can buy and you can sell, but like I said, the problem is not a lot of traders know where to exit. So you also, my golden rule is, and I always tell my members, is a lot of traders make the mistake that think they need to use two different strategies for their entries and exits. What I mean is, don't think that you cannot use one thing for entries and cannot use it for exits. Now that's okay, but you have to, something needs to stem from your entry strategy to your exit strategy. So if you're looking at a resistance zone and you're buying off from the break of the resistance zone, you need to close that damn trade once it breaks back below the resistance zone. Don't hold on to the loss. You know, the very same thing that gave you an entry should be the very same thing that sort of convinces you to close that trade, or maybe another resistance zone, something like that. So next time you see a MadBlock and the market is hitting a MadBlock and then it's reversing against you, that MadBlock is respected. So hope you enjoyed this video. Let me know down in the comments what you guys think, and I'll see you in the next one.